Money FM 89.3, Singapore's most influential radio station.
You are indeed in the Breakfast Huddle with me, Manisha Tang.
Good morning. This is your finance news with me, Ryan Huang.
I'm Michelle Martin. Good morning.
Good morning. I'm Adrian Abraham.
I'm Clarissa Monter for the Workday Afternoon.
This is Prime Time on Money FM 89.3.
I'm Rachel Kelly.
Tuesday was a good day for markets. Weekend mornings here on Money FM. Glenn Van Zutten with you.
Money FM 89.3.
Hello, welcome to Money Matters, and my name is Ryan Huang from Money FM 89.3. Thank you all for joining us. Great to see you all here. And today's topic, we are diving into CPF, and it's split up into two parts. We've got one part today and one part next week at the same time. And today we are diving into the how and the why you should be investing in your CPF. So it's going to be an hour long or so, and we will get a chance to have everyone in the conversation as well. So throughout the session, if you have any questions, any comments, just fill it up in the comments box and we will get to them at the right time. And here's a quick disclaimer before we start the ball rolling. So as usual, everything you see here or read here is going to be just for educational purposes, and everyone's circumstances is different. So please seek financial advice before you take action on any of the information that you're going to be hearing later on. And also, we've got some goodies for you. So if you have any comments or any interesting questions and you put it up in our comments box, you can also stand a chance to win some exclusive Money FM 89.3 merchandise, as well as Ivan's book. It's all about firing up your retirement. I'll let him talk a bit more about his book in a while. And of course, if you have any questions, fill it up in the box. Before we start the ball rolling, I want to get everyone to test their Facebook comments page first. And here's a quick question, a bit of a poll. Have you used your CPF to invest? Just fill up yes or no, and you have invested in it. Just let me know, what type of investments have you gone into before? Is it stocks? Is it gold? Just fill up in the comments box so we have an idea that everyone can hear us clearly and the comments box is working. So I'll just give a couple of minutes for everyone to fill it in. In the meantime, let me introduce you to our guest today. He is Ivan Guan, and he's an independent financial consultant. Of course, he's also the author of the book that we are giving out today. Ivan, welcome to the webinar.
Hi, Ryan. Good afternoon. Glad to see everybody here.
Now, Ivan, I'm just getting the comments coming through. So let's get a bit of a gist of what your book is about that we're giving out today.
It's about how to achieve financial freedom and retire early. It's basically sharing my personal experience and my years of experience managing a retirement portfolio for clients.
Yeah, so you've been in the business for around 16 years, right? So you've got a lot of experience, a lot of insights to share, and we will get a chance to go through all the mistakes that people have been making, the misconceptions, what people normally don't really understand, because CPF is such a massive topic. Even after so many years in the industry, I'm still struggling to catch up with everything, all the changes that have been happening over the years. So Ivan, I think you're the best person to help us walk through everything we know about CPF, why you need to invest, and how to invest. So Ivan, looking at the comments right now, a lot of people actually have used their CPF to invest. There are a few no's, so that'll be helpful for them to find out how they can do so. And a couple of them have invested in ETF and shares. And going by the comments that we're getting so far, is that a good gauge of the take-up rate of CPF in investments?
Yes. I think to a certain extent that most people have invested in the certain instruments, but many people just invest on an ad hoc basis. I think from my experience that people do invest when they come across, for example, their financial advisor approach them, or they show a promotion from the banks, then they do something about it, but that's normally one-off. But investing for CPF is actually a long-haul journey, as we all understand. So it's for the retirement purpose. Yeah, so I think most people don't have a portfolio for that.
Yeah, I can see a lot of people investing in unit trusts, a lot in funds. So like you pointed out, it's not at the top of the mind when it comes to investing, and it's really something that you can take advantage of regularly. Now, Ivan, I'm going to let you start your deck right now, your presentation, why and how. So give us a bit of your background with your journey into this financial industry.
Okay. Shall I start with my slides?
Yep.
Okay. So I just give a bit of background of my journey if you're not familiar with me. First of all, I'm the founder and do everything for igmoneymatters.com. I run this blog for, I think, about 12 to 13 years since after my financial advisor journey. And I also wrote a book about 4 years ago called 5-Year Retirement, 3 Simple Steps to Achieve Your Financial Freedom and Retire Early. This is to summarize my years of experience to my personal mistakes and the mistakes I see from many other people. And then I'm also professional-wise, I'm a fee-based financial advisor. My main focus is to help my client to invest their money for retirement purpose. And I'm specialized in early retirement. We can talk about this a bit later because early retirement planning and the retirement planning are not essentially the same thing because we are talking about different time frames and different assumptions. And also that I'm a qualifier for $1 Million Roundtable. It's just industry-wise recognition about the asset under my management. I will just move on to what we are going to talk about today. So in today's seminar that we'll talk about a few things. There'll be 2 sessions as Ryan has mentioned. So the part 1 is that we're talking about why you should invest your CPF. But before that, I'll talk a bit about financial freedom and what is the CPF role in your investments and what choice will you have to invest in your CPF. On the next second session, I will talk about how you can get started with CPF investment if you never did so. What are the things you have to look for? So how to open a CPF investment account, how to consider when you set up an investment portfolio, and should you invest by yourself or engage a financial advisor? And so let me start with talking about financial freedom. Why do we need to invest? The reason is that because all of us, we have this thing called human capital. This is the thing that most of us may not realize when we are young. What happens is that when we are young, we have a high human capital, which is our financial capital. If you think about it, it's all your future earnings from, let's say, 25 years you start to work until the day you start working. But our future earnings actually reduce when we are older, right? Because the number of years we are going to work become less and less. But at the same time, our financial capital is going to increase. So we have to work until the time that our financial capital can replace our human capital. Then that's the time we can actually start working. And that is time actually we talk about what is called financial freedom or retirement per se. So we need to understand this concept. It's very, very important. I hope all of you can take a screenshot of this one. So I think you can use this as a framework about when you do your personal financial planning. And the financial freedom essentially means very simple. It's your passive income more than expenses. So if we look at the previous chart, when we are working, our active income, which is your salary, your business income, which is actually paying for your expenses, and you have some savings. The time that when we reach this stage is when your passive income, that means when you are not working, your financial income is able to replace your expenses. And that is time you can choose to work and you can choose not to work. You can choose to work and work anything you like. If you don't like your boss, just fire your boss. But before that, you don't have the luxury to do this. So how do we achieve passive income? So in my book, right, I actually draw this framework, which is actually all of us have gone through in our entire financial life. So you think about it, when you are working, you have an earned income, no matter whether you are doing a business or you are doing a salary job. And you have your savings, you pay off your liabilities, pay off your expenses, and that is your net cash flow. The only thing you can do is that you have to make use of cash flow to generate some income generating assets. That means you need to build up a financial assets for yourself. And the income generating assets can be in many forms. That's the thing that people normally get it wrong because they may think about only one thing. For example, you may say that, okay, my retirement rely on my property, or some people say I rely on my CPF. Some people say I rely on my bank savings, but you don't have to just settle down with one because they can be in many forms. So I give some example. For example, stock dividends. For example, insurance products. Of course, your property rental, real estate investment trust, and annuities and CPF lives. So all these things are the part and parcel of your retirement income. And what we need to do is that we need to achieve as many sources of income as possible. So if one layer of the income actually has some issues, that you can continue your retirement life. Otherwise, let's say if you just rely on one thing, which is your property, and if let's say there's something happening to a property or something to happen to the property markets, your retirement can be affected. So that is, I call the Quilapi concept in my book I mentioned. So you can think about your retirement income into different layers. So we all know what is Quilapis. So Quilapis, you have many, many layers. So you can think about your retirement income as the three main layers. The first one is a guaranteed income. Guaranteed income means that it's the income that you will almost certain that you will have. For example, as I mentioned, your insurance, bond investment, bank savings, and the CPF lives. This is the thing that almost certain that you are going to have, regardless of the market conditions or economies. And if this is not enough, you need to have a variable income to boost your investment returns, which is, for example, stocks, property investment, or real estate investment trusts. And if you are lucky enough, you may have inheritance, you may strike a lottery, or your children is very good. They pay you support so give your family money to support you. All these things are called the bonus income. So when you do the retirement planning, you can't really plan for your bonus, but you can plan for your guaranteed income and you can plan for your variable income. That is what we are looking at when you are planning for your own retirement. So as we can see, the role of a CPF is actually lying down on the guaranteed income portion. And this is, you need to bear in mind. Can you retirement entirely depends on the CPF? It's possible. It's only if you have a lot of CPF. Otherwise, if just you have 100,000 or 200,000, you are not going to make it. So sometimes people say, "Oh, I don't want to invest CPF because I don't know how." Actually, you're already investing a CPF. So there are two main forms Singaporeans are investing. First of all, is you earn interest. So interest is a form of investment. For example, currently your ordinary account and a special account earn you interest. And when you turn to 55, you can have a retirement account and also earning a higher interest. And the CPF is very, very generous. They give you a very, very high interest. This is compared to many other parts of the world. There is no other countries paying this kind of returns as what the Singapore CPF is paying you. I will discuss this a little bit more because they have a greater impact about what is going to happen in the future. The second thing is that many people use CPF to buy property, and it is also a form of investment, right? Because the reason that you are willing to withdraw your CPF to pay for your house is because that you believe, first of all, you have a roof to stay, and you believe that your house value will appreciate over the years. Yeah. Otherwise, you won't use your CPF to pay something which is depreciating. So this is also a form of investment. So this fall into just now. I remember I mentioned about the credit piece. These are the guaranteed income and the variable income.
But yeah, that's a very good point about property because a lot of people actually just use CPF for property, and you actually have to pay back the CPF account one day with interest accrued. So that's something I think it'll be interesting to dive into later on.
Yeah, and actually I saw research. Does the property actually outperform after you pay off all the accrued interest? We can share that later. So, but I'm trying to say is that this is the basic way for people to manage their money. But I always tell people that if you want to be a millionaire, you need to do what the millionaires do. So research shows that millionaires globally, they don't just plunge all their money into real estate. In fact, they probably only plunge about small portion of their money into the real estate. And they actually have a very good balance between equity with stocks, cash savings, bonds, and other alternative assets. And this is what the Singapore most people are lacking of, because Singaporeans, as we all know, most people are asset-heavy, cash poor. And through my years of experience, I did witness that many people have a very expensive houses, but if we dive into their retirement savings, it's actually very little. And if you were to ask them, what would you do with your retirement? They always say, oh, I will sell my house, I downgrade. But then again, would it really happen? When you enjoy the luxury of life, would you be able to really downgrade? Then I think that is a big question mark. So we need to be responsible about our personal finance in that manner. So who can actually invest in CPF? Actually, CPF scheme have a long history. I won't talk about the entire history. It's been like 30, 40 years. And over the years, the CPF investment scheme have also evolved. What you can do with CPF, what you can invest. But in today's context, most people can invest their CPF money. All you need to do is that you need to maintain 20,000 in your ordinary account and 40,000 into special account. And of course, you're not bankrupt. Then you're able to. And since 2 years ago, that the government mandate that anyone who want to invest CPF, you must take a self-awareness questionnaire, which is very, very good because sometimes people invest because they are told to invest, but they actually don't know what they are investing into. So a lot of people have complained about their CPF investments, which through my 15 years of experience, I also witnessed that through the global financial crisis, through many things which has happened in the past. So I think this is also a good move. The government's regulations are making CPF more friendly and less risk exposed for people who are not so financial savvy. So just to give you a summary about what you actually can invest. So you can see that you have OA and IC. From the regulation point of view, government is okay that you invest in ordinary accounts for most of the investment products. But for special accounts, they prefer that you invest in low risk products. Well, of course, low risk products are in traditional sense. If we zoom into this topic, if you read some of my articles recently, for example, bonds is no longer a safer product because of the rising interest rate environments, because of the rapid dropping of our bond prices. So the same financial instruments may play a different role over the years. So I think that probably in the future they will take it as well. So as of today, this is what's going to happen. So you can invest in shares, but later I'll zoom into the details. Property funds or REITs, gold, unit trust, and the ETF. This is a common thing that the people invest. But you may not realize actually you can also buy bonds, insurance, Singapore government bonds, and even fixed deposits. And I'll just discuss a little bit more. So Singapore government bond used to be a viable instrument for CPF, but it's no longer because it's very simple. Over the years, the interest rate we all know have dropped so much. So you see, if for Singapore government bond is merely less than 2% returns, even from the longest period. So since CPF is giving you at least a 2.5% interest, the Singapore government bond does not make any financial sense for you to invest into. And also about treasury bills. Treasury bills is essentially a short-term government bond. You can see the yield is even lower, like 0.4, 0.38%. So it also totally doesn't make any sense. But this is in the past, as I mentioned, right? Things change. Going forward, when the interest rates start to coming back, and things may change a lot. And we have to still look into all these possibilities. And recently, these few years, there's some new fashion that people like to transfer their money to special account because a special account earn the higher interest. Actually, you need to do a bit of planning for that. Don't just blankly listen to what people advise you, because many people doesn't understand how special account works. So special accounts, actually, the way it's structured is as same as a corporate bonds. So if you read the CPF website, they say that the CPF money are invested in special Singapore government securities. So this is actually a bond. This is actually a bond. So what happens is that the government use your money to invest, and they guarantee your return through the bond structure. And but this structure of the coupon is not fixed. So if you read the details, right, what it's actually saying is that the interest rate that government is paying you should be 10% of Singapore government security plus 1%. So 10-year Singapore government bond plus 1%, or a floor rate of 4%. So as of now, this formula, if we were to calculate, actually the yield is only about 2%. So by right, the CPF is only supposed to pay you 2%. But because we are so lucky that the CPF want to take care of you, so they impose a floor rate of 4%, so to pay you a high. But this 4% is never a guarantee in the first place. It will be reviewed every year. And you need to understand that when you transfer your CPF to special account, it's irreversible. You cannot switch it back. So you need to take into considerations of a long-term effect of this transfer. Yeah, I'm not saying that whether it's correct or wrong, but you need to know what you are doing. And this is the historical returns, which you actually can download from the CPF website as well. As you can see, ordinary account, CPF only supposed to pay you 0.09%. Or special account, as I mentioned, 2%. Medisave and retirement account is also about 2%. But the actual fact, right, CPF is actually paying you much higher than they are supposed to. So we can count ourselves lucky, but this is beyond we are supposed to get. This is all I can say. And of course, you can invest in gold and gold ETFs. This is up to 10% of your investable savings. Investable saving means your CPF balance plus the money you have withdrawn from your CPF. And you can buy shares, REITs, bonds up to 35% of your investable savings. So if you want to know that what you can actually invest, you can log in. There's a link. You can go to the SGX website. There's a stocks under CPF investment schemes. You can list down all the stocks you can buy. But essentially, you can only buy Singapore stocks and Singapore REITs. So which is actually very, very limited. Very, very limited. Because Singapore, we all know, is a small economy. Actually, the Singapore market was not doing very well for the past 10 over years compared to other stock markets in the world, like China and the USA. And if you limit yourself to individual stocks, you can only invest in Singapore economy, which is very, very limited. So I'll talk about what you can do later. And you can also, of course, you can buy funds including unit trusts and ETFs. So if you want to invest globally, the best vehicle in CPF investment scheme is through unit trusts. Because unit trusts, as long as the fund manager can decide which region they want to invest, they can invest in many different parts of the world. And talking about ETF, it's the same. You actually can only invest, only five ETF are approved under CPF. Essentially, it's 2 Singapore bonds, 2 Singapore STI ETFs. That's all. And a gold ETF as well. So only 5. So there's no much difference when you're investing in individual stocks and ETF. Your risk exposure is contained in Singapore. But CPF approved unit trust is a lot. I won't go into the whole list for you. You can actually search, for example, you can go to Funds Format. You just search the payment mode. Is a CPF available? You generate the fund list. You can see all the things. I think it's about 200 to 300 funds that which is available. Then you can use these funds to structure a portfolio for yourself. How does the CPF investment funds doing? So actually, CD has a compilation about what happened in the past. So many people say that the CPF investment cannot outperform the interest, which is not true. In the recent years, because the Singapore is not doing very well, but let's say just the recent years, since 2015, there's 2 occasions that most people actually make money from the CPF investment. And actually, if we look at the last year, this is only until Q3. The Q4 data is not available. If we're talking about Q4 data, I say that at least 90 to 95% people actually make more money than the CPF interest. Because last year was a very special year for active fund managers. I will talk about that in the future. But you can see as of Q3 2020, as long as you invest in the bonds, equity, and the mixed assets, you already earn about 5 to 6% returns. And over the long term, your average return is about cumulative return about 11% over the 3 years time frame. Yeah. So the last thing that before we take the Q&A, I just want to share with you a story. This is the thing that I share with my client often, but if you are not my client, you may not heard of this. So story is about a farmer. A farmer, once there was this farmer, right? The farmer offended the king. So the king sentenced the farmer to death sentence. What the farmer do is that I plead to the king to say, give me 5 years, I can make your horse to talk. So the king feel it's very interesting that how can this man make my horse to talk? So the king say, okay, I give you 5 years. 5 years later, if my horse doesn't talk, I will kill you again. So on the way out, the farmer's friend asked him, why are you so reckless? How can you make the horse talk? And here this is what the farmer said. The farmer said that, 5 years is a long time. A lot of things can happen. Maybe the king might die in 5 years. And maybe he already forgot that he sentenced me to death. Or maybe I already died within the 5 years. And who knows, maybe the horse can talk. So why am I talking about this story? Because I want to explain to you retirement planning, CPF investment per se, is a very long period event. It's going to be stay with you for the next maybe 10, 20, 30, 40 years. And sometimes you may heard of certain narratives in the market. People may tell you certain things which make a lot of sense in today's context. But you need to understand that in the next 20 to 30 years, things do change. And a lot of things may not hold anymore. So when you do retirement planning, do keep an open mind and keep on learning and adapt your retirement strategy with the entire environment. Yeah.
Yeah, I think that's a
Ryan,
very good point.
Mm.
Because the world changes, and who knew we will get into a world of negative interest rates at one point, right? So you do have to keep yourself up to date and also regularly assess your retirement plans. And I have a couple of questions coming in that we want to get into. But before we go into those questions, if you like what we are talking about so far, please like this video so we get a good idea if we are on track and we can continue on this same direction. So let's dive into some of the questions that are interesting, and we won't get the time to go into everything, so we'll try to cover as much as we can. So here's one from Nick Go. It's also quite similar to one from Chris. So considering the range of different investment options out there for CPF, how much diversification is adequate for a good balance of investment mix? Because at the end of the day, CPF is supposed to be for your retirement. So it gives you the idea it's supposed to be conservative. But at the same time, you are thinking about going into stock markets as a potential investment. So how do you weigh and balance this two? If you go to stock markets, what type of stocks do you go into?
Yeah, that is a very good question. In order to answer this question, we actually just by the way, we are going to have another seminar next Wednesday, and I will zoom more into details about the CPF investment strategies. But just give you a very high level point of view. When you invest your CPF, you shouldn't take it as an isolated investment. So your CPF investment should be gel together with your cash investments, with your SRS investment, with your whole entire retirement portfolios. And you can do the risk diversification within the entire portfolio. For example, if you already invest heavily in stocks using cash, then maybe your CPF, you can be a little bit more conservative. Let's say you don't really have a lot of cash, but you have a lot of CPF. Maybe you can take a bit more risks into your CPF investments to balance out your entire risk exposure of your net worth.
Okay, so that's a good point. You shouldn't take the CPF investment as isolation. It needs to be part of an entire portfolio consideration, right? And I think this is also an interesting point coming through from Kai Heng Kwok, where it's a bit of a tip, sharing his or her experience that you can move your stock holdings from a CDP to your CDP account and close your CPF investment account to save on fees. Is that something that you think not a lot of people know, Ivan?
The fees is actually very insignificant. Insignificant, I would say, like maybe like $2 or something. So, I mean, I don't think that there's much difference in this aspect.
Okay. Well, if that is an option, if you want to exercise it. So another question coming in from Dev So, and this is about insurance, right? Should we make sure we are insured fully before we start any form of investment, including using CPF? Because once again, that is the kind of a backstop for retirement. Should we be taking care of insurance first before we start looking at investments?
There's a two aspect of this one is that should you look after your insurance first before you invest? Okay, so I think the question is that should you look after your insurance and investment, including okay, I understand the question. So okay, I think that you can actually do concurrently. There's no conflict between insurance and the investments. That is where the financial planning comes in. So, for example, if you feel that you have a lot of savings, and you maybe can buy, let's say, insurance products, and you can invest not so. Let's say you buy savings plans from insurance, but you don't invest so much in stocks and shares. But let's say you have not much savings, but you still want to achieve protection and investment at the same time. You can buy those low-cost insurance, for example, term insurance, and invest the rest of your savings. So I think that again we need to take a look at this in a totality instead of isolation in this area.
Okay, thanks for all your questions, everyone. Keep them coming in. We will have another opportunity to answer all your comments and your questions as well. Ivan, I think we can move on to part 2, how to get started with CPF investment.
Okay. So let me just recap what we have talked about. So just now we're talking about why you should consider CPF investment and what are the roles in your retirement planning. As I mentioned during the Q&A as well, CPF investment should be looked into in totality with all your other financial assets. You should not isolate whether you should invest CPF or not invest in CPF. So with this in mind, right, then you can make a better decisions. Okay, so we move to the part 2. How do we get started with CPF investment? This one may be new to some. Even let's say you already started with the CPF investment, they may not be some of the details you may not be familiar with. So I just run through the basics. So first of all, there's 5 steps for you to invest CPF. As I mentioned earlier, before you do any CPF investment today, if you don't have an account, you need to do a self-awareness test. This one can be done in the CPF website. It helps you to understand what is CPF investment all about. And secondly, that you need to have a CPF investment account with an agent bank. This is for ordinary account investments. For special account, you don't need to go to an agent bank. And thirdly, you need to open the investment account with an investment platform. So investment platform can be a stockbroker or what we call investment CPF investment administrators. Later, I will explain to you what is called CPF investment administrators. And the fourth thing is that you need to construct a portfolio and place your first order to invest your CPF. The last thing is many people actually overlook is that when you start investing in your CPF, don't forget about it. You need to remember to monitor it and review your portfolios from time to time. Because things change, as I mentioned, you see how much things have changed for the past 1 year, many things. So if you have a fixed investment, may be good at the time, but after half a year, it may no longer be good, but things change. So monitor and review is a very crucial step for CPF investment. So I just run down some details. So first of all, the CPF self-awareness questionnaire have 2 sections. So first of all is understanding about investments. Secondly is about investment products, which I mentioned earlier. And the agent banks, you can only have 3 banks to help you to withdraw the money from your CPF in order before you can buy shares or unit trusts. So this is DBS, UOB, OCBC. as just now the person mentioned that there's some bank fees, but it's not a lot. It might be $2, $2.50, depending on which bank you use. And CPF Investment Administrator is a platform. There are 4 CPF investment administrators now. The difference is that when you don't use administrator, and when you buy or sell funds, for example, every time your transaction actually go through the agent banks, and every time there will be a incur because the agent bank actually providing services to you. What happens is that when you have an administrator, let's say for example, iFast, Viva Navigator, Philip Security, or UOB, what happens is that they actually withdraw your money, and they will not pass back the money to your agent bank. So because the money no longer pass through the bank, so there will be no bank charges. So in this manner, right, you actually can save a lot of transaction costs if you are frequently buy and sell your CPF investment holdings. So I will highly recommend you to use CPF investment administrators for your CPF investments. And of course, you need to consider your individual circumstance and about CPF investment. For example, where are you investing? What is our time horizon? And what kind of risk levels and downside risks are you willing to take? And also, what are the charges involved for different investment instruments? If you have a financial advisor, you can discuss with your financial advisor about this. If not, you want to DIY, you also have to consider all these factors to make sure that you make the right decision. So I just want to give you a framework about investment. I will talk about this in more detail in the next week session. But I want to give you an idea about investing is not a linear thing, because many people think about investment as something, what is a good investment? Which fund is good to buy? Which stock is good? So that is a typical people's question. From a portfolio management point of view, your portfolio should adapt when the time change. Most people have 2 main stage. The first one is before your retirement. The other is after your retirement. Your investment objective and the focus can be very, very different. So if you are like in your 30s or 40s, you are still focusing on wealth creation to generate as much return as possible. So you may have a more growth mindset. So you can take a more risk exposure per se. And when you post-retirement, you probably want to tune down your risk exposures and focus on income. This is just a broader framework. Of course, in different stage, even within the growth or income stage, you can still have other considerations. I will talk about more in the next week's session. And the last one is that you need to monitor your portfolio, as I mentioned. Has your investment goal changed? Are you nearer to your retirement? Should you adapt your risk exposures? Do you have a new financial objective? For example, do you want to buy a bigger house? If so, you may want to draw down more of your CPF balance. Or maybe you are selling a house, so now you have more CPF balance to invest. So all these things will determine that your investment strategy. And if you are investing something which is not doing very well, a lot of people will just say, I just leave it and hope one day it come back. My advice is that you need to understand why the investment is not doing well. It's because you actually choose the wrong product. And it's really a time for you to cut loss and move on instead of just praying for the investment to come back, because there are many investments which go down will never come back. I've seen that many, many years. That's why CPF investments used to have a lot of funds, used to have many, many more funds than today. But a lot of funds were delisted by CPF board because of the poor performance. And if you're still holding on these funds, they'll be detrimental to your long-term return. So essentially, to summarize, this is the structure about what happens when you invest CPF. So you can do DIY or you engage a financial advisor to help you through an investment platform. And the platform will give instruction to the agent bank. The agent bank will in return to buy all these investments and pass back to the investment platform. So that is the flow of your CPF investment. And I mentioned that you can through advisor or can DIY. And then nowadays there's something in between which is called the robo-advisor. There's only one, as far as I know, there's only one CPF approved robo-advisor, which is Us. So you can check them out. May be suitable for you, may not be suitable for you. Yeah. And if you engage a licensed financial advisor like myself, maybe you have a different level of services, different options. So this thing you can do if you never invest before. Go to explore. It's very open. Don't need to say I don't want to talk to financial advisor, or I just want to DIY, or I just want to do robo. Keep an open mind and go to explore different options and find the one which is more suitable for you. What I want to highlight to you is that based on this, this is a research done by HSBC. So they actually surveyed the people who engage financial advisor for retirement purpose and people who do not use a financial advisor. As you can see, right, this is talking about whether they actually achieve their retirement saving goals. So you can see that the people who engage a financial advisor, they may be likely to achieve a better goal because actually you have someone who are working together with you along the side. I do the monitoring and the review purpose. This is typically a DIY person. You don't have the energy, you don't have the knowledge and the time to do so. But of course, not financial advisors are created equal. You need to choose a good advisor. This one you have to survey and do your own research. What I'm trying to say is that at the end of the day, right, all these things we are just talking about is a theory. Before you do any investment, it's like you're standing at this edge of the roof. You look downstairs, investment is very deep, very dark, and very, very dangerous. And you need to make a first step. If you are willing to put in the effort to do all the research by yourself, you can have the first step by yourself. If you think that you cannot do so, you need someone to help you, get some help. At the end of the day, if you are not moving, nothing will happen. Your wealth just will be stay there. You work forever. You cannot stop working because the moment you start working, you have no more income. And the last thing I want to mention is about this Dunning-Kruger effect. This is what happens when you trying to learn something new. Typically, people, when you, let's say, for example, you read investment forum, you hear people discuss about investing, you need to step back, take a step back, and do some logical thinking first. Because a lot of times when people learn a little bit of things, they think they know everything. I've seen it so many times, judging from people, how they talk about in the forums, how people give other people investment advice. When they learn a little bit, they think they know everything. But the reality is that investment is a very, very broad topic. The more you learn, you will think that it's actually more complicated. And you will start to question yourself, how much more do you have to learn? So we all have to go through this stage. Even myself, when I started investing, I also think that, oh, investing is nothing difficult. I can do this, I can look at this chart, I can read this report. At the end of the day, when I start to really investing my own money, it's a different story. So I think that you need to be very aware of this curve. At a certain point of time, you'll be competent with the help of advisor or without help of advisor. But don't jump into conclusion to say investment is easy. I just go forum to ask what is a good investment. Then some people will give you some ideas. Just take it. Oh, that is good. Then I just go to invest. Do a bit more homework before you start anything. So that is pretty much about what I want to share today. I just give you a summary. What we have learned today is that, first of all, we're talking about the CPF role in your financial freedom and what are the investment choices you have and how to get started with CPF investment. I didn't talk too much about the strategies and the instruments because this is the topic we are going to talk about next week. So do come back next Wednesday at the same time. I was talking about how to do financial planning with your CPF and what are the right strategy and instrument to use. And also that the CPF investment actually will also affect your legacy. If you're old, how does it affect your estate planning? So these are the topics that I will talk about. I will cover in the next session. So I want to leave this picture with you behind is that at the end of the day, you need to jump. If you don't jump, you just read the forum, you read 100 books, you can do 100 research, you do this and that. You are not investing a single dime of your money, nothing will happen. Your retirement will not progress. So I hope this can give you some motivations and to move on to the next step.
Yeah, that's a very good point. Sometimes we read so much, there's a bit of analysis paralysis. We can't be perfect when we make our investment decisions. Sometimes we have to learn along the way. And also, if you don't know everything, actually, you don't know what you don't know. So it's best to talk to an expert where you can bounce some ideas off them and then make up your own decision after that as well. So that is one advice I've always carried with me. Always take the first step, even though it might be a small step. It will help you to learn along the way. And Ivan, thanks for helping us to walk through some of the fundamentals of why, as well as how to invest your CPF. Of course, we'll be covering more next week. In the meantime, we do have a couple of questions that I think we can cover. And I'm going to put up this one on annuity plans first. So this is one coming through to ask you about, are there any options in terms of annuity plans that you can use your CPF fund to buy? Any thoughts on this, Ivan?
Okay, there used to be annuity plans, but in today's context, there's no more annuity plans. The reason is very simple, because there's no financial institution or insurance company is able to deliver return which is better than CPF interest guaranteed. Because just now, you remember I showed you the table that the actual return that the CPF get with your money is about 2%, but they are paying you like a 4% return. So in reality, no insurance company is able to offer a product which give you that kind of returns. So so that's why all the CPF annuity has been withdrawn at this moment. But I do believe that when the interest rate normalize in the coming years, which is already happening today, annuity will come back at a certain point of time.
Okay, here's another interesting one, a comment from Janice talking about ILPs. It's a bit, I guess, digressing a bit from the topic. So what's your view on ILPs? So her comment is how she's invested in them through OA and SA, but they never pay any dividends at all. Is that something you think is attractive to you in this current landscape right now, ILPs?
Okay. Actually, first of all, there are two aspects of this question. I talk about the dividend first. Whether the fund pay you dividend at all actually is irrelevant. Because the dividend is, this is the thing that the people normally misunderstand. A dividend is a left pocket or right pocket. You think about the fund, let's say it's $100. If they pay you $2, the fund will become $98. So it's left pocket, right pocket. There's no meaning. So don't focus too much on the dividends. In terms of investment link policies, yeah, it's true, because investment link policies is insurance products, and the insurance as a medium person, they do have to take some charges, so make the CPF a bit more expensive. But then in today's context, it's a bit different again, because last year CPF actually regulated how much charges you actually can impose for CPF investments. Now the maximum charges is 0.4% only. So even if it's LP, they still have to obey for the same kind of fee structures. So the high fee structure was in the past. Going forward, there's no more high fee structure. But in my opinion, I think you're still better off with direct investments, because just now I mentioned about the CPF investment administrators. CPF investment administrators can invest anything under CPF. If you invest with an insurance company, you can only invest the approved funds with an insurance company, which you have limited choices. So I recommend you to use a CPF investment administrator, the four I mentioned just now.
Okay, Ivan, there's one comment here I thought it'd be interesting, because this and a question that keeps popping up, right? Can we, or do we need to pay back our CPF after you use it, in terms of course, when you buy a property, there's accrued interest to pay back. How about in the case of stocks? What's the scenario here? Just to clarify for everyone.
So for investment, you don't have to pay back whether you make money or loss. It's nothing to do with accrued interest. There's no accrued interest for investment. But for property, yes.
Okay, and another question coming through, I think, is something about tips and tricks in general, what we should do with our CPF funds, and also number two, before we reach 55, and what do you do between 55 and 65, and what do you do after 65? So 3 stages of advice for different parts of your life cycle.
Okay, so you remember just now I showed you a retirement investment framework. From a very high level point of view, you can follow the framework. So when you are before retirement, focus on capital growth. And when you're 55 to 65, it's more like a transition period. You can try to adapt your investment strategies to your life stage at that point of time. But I want to highlight to you is that you cannot isolate, you cannot determine your investment strategy based on your age. Okay, I just repeat, you cannot determine your investment strategy based on your age because the investment market does not care about your age, right? It doesn't matter whether, it doesn't say because, oh, now you are going to retire, so I make the market easier to invest for you, right? So if it's a tough year, it's a tough year. If you are 55 last year, you have a tough year. So you need to adapt your investment strategy based on the market cycles. Are we on the bull market cycle or are we on a recession market cycle? So that is the primary framework you should use, not based on your own age.
Yeah, this is actually very similar to a question from Maureen, where she's asking, I imagine she's retired right now. And if you think about stock markets, it's usually a long-term game, right? Is that something that people who are already retired should be looking at stock markets when the runway, so to speak, is not as long as someone who's younger?
If you're already retired, you really have to look at your entire net worth. You cannot isolate CPF from your other assets because that is all you have, right? So when you retire, you have no more income. You take stock about what you have, how much property you have, cash, stocks, CPF you have. Then do a planning from there. Yeah, you cannot isolate it.
Okay. And here's a question about OA and SA transferring. It's a bit long, so I'm just going to help you walk you through it. What's your view on transferring from OA to SA, topping up the SA versus investing directly with OA and SA in the markets? Because different accounts will bring you different returns. So how do you decide what to do with the various accounts in your CPF? How should you balance your portfolio?
Okay. I think I mentioned just now about, I mentioned a bit about ISA transfer. There's nothing wrong with ISA transfer. The question is that how much are you willing to put under ISA? Because when you transfer from OA to ISA, you have less OA to use. That means that maybe they will affect your balance to be used for your properties in the future. As I mentioned, it's a irreversible process. So maybe in the future, you want to buy a property and you realize that actually you don't have enough money, but you have a lot of money in the special account. So you need to do a bit of long-term planning for that. And in terms of topping up SA as well, some people like to use cash to top up SAs. That is okay. You also have to look at your individual circumstance because if you have a lot of money, and really nowhere to put, then you really can pop out to SA because anyway they're earning a 4 to 5% interest. But if you only have maybe $20,000, $50,000, and still trying to squeeze all the cash just for the bit of interest, that may not be a wise choice. But I think you need to look at the whole thing as a totality.
Okay, I think we are just running out of time for everyone's questions. So I'm just going to put this one up for you to kind of conclude with, right? A takeaway for everyone to think of as they go about their day. How can we retire comfortably in Singapore? What are the small daily steps I should be taking towards such a retirement? What are the, I guess, ABCs or 1, 2, 3 steps that you should be starting to think about when you think about how much you want to have when you are at retiring age? Okay.
I actually talk a little bit about this in my book, which I mentioned about, I call the mini retirement. A lot of people, we cannot imagine how retirement actually looks like because we only retire, most people only retire once, right? So, and you haven't experienced it. It's just like you never get married before. You don't know how the marriage look like, You don't know, never have a kid before, you don't know how. You can't imagine. You can study, you can read, you can research, but you won't know. The best way to know is that to take a mini retirement. For example, now take 1 month off of your work, or maybe you are in transition of your work. Don't eager to find the work. Let's just think about when you have the time, when you actually slow down, how does the life look like? How much money do you need to spend? Have a mini dry run for your mini retirement. And then you will have a very good idea what is going to happen in the future. And then use that as a framework to plan for your retirement.
Okay, that's a very nice thought to have. Think about your retirement, a mini retirement, what you're going to do when you are slowing down, maybe more Netflix and more chilling at home. So think about that, what that future might be. And of course, we will be able to catch up with you next week again, same time, to talk more about what you can do with your CPF, planning for retirement and other life goals. If you like today's session so far, please like the video so we are able to give you more similar topics, as well as like our Facebook page so you can be notified of the session next week, as well as subsequent sessions that we are lining up for the year ahead. And also just a plug for our Money FM 89.3 newsletter. Every week we have an email newsletter that we send out. This is a preview of what to expect in the week ahead in terms of business developments, market, corporate actions. So everything you want to know about a week, we will be sending it out on Monday morning. So if you want to subscribe to it, just head on down to our Facebook page, or rather our website, and there will be a button for you to click on subscribe now, and we will be able to communicate with you and share more. So also in the comment section of the Facebook page right now, we have a bit of a link, and you can send us your feedback through this form. What other topics you want us to cover? What other comments you have for us? So we can plan around what you are interested in. So send us your feedback, and if there's anything interesting as well, and we also want to reward our listeners and viewers, so we will also be sharing some merchandise with you for some of our lucky winners. So once again, we are giving out one of or two of Ivan's books today. So we'll be sharing or picking some of the winners from the comment section later on, and we'll be in touch with you once again. So everyone, thank you so much for sharing your time with us. Ivan as well, thank you so much for sharing all your insights from all your decades of experience. I think we have a lot more we can cover next week. So stay tuned, and we'll catch you again soon. Thank you.
Thank you, everybody.